As for whether the rotation can revive its momentum, let's bring in Ned Davis Research's chief U.S. strategist, Ed Clissold. Ed, wondering what your work is suggesting to you about whether this rotational move, this huge rush higher in smaller stocks and the broad list of stocks has good meaning on a forward-looking basis.
Yeah, so for the broad market, it does have a good implication because what you want to see are most stocks rallying together. What you don't want to see is a very narrow market where just a few stocks are rallying, everything else isn't. And we kind of got into that situation in the second quarter where the mega cap growth stocks were kind of the only thing going up. And so what this rotation has done is created a percentage of stocks above their 50-day moving averages, got above 70% earlier this week. That's a positive sign. And then we had another thing. It's looking at the 5-day advancing stocks. All those stocks went up in a day versus for 5 days in a row versus all the stocks that declined for 5 days in a row. And that got to a really high ratio above 3 times. So that when you get something that strong, it usually means the next few months are going to be positive for the market. So this kind of rotation for more boats rising with the tide tends to be bullish for the market.
And then put that into the context, I guess, of the general cyclical outlook, because it's all happening as we, I guess, are gaining some more certainty about, soft landing, Fed rate cuts, perhaps the election. How does that filter through to your view?
Yeah, these things don't happen in a vacuum. They're happening for a reason, and it's the macro fundamental backdrop where, a lot of people were looking for the Fed to cut rates at some point this year. We got some clarity with the CPI report and Powell's comments that September looks like the likely first cut date. And so now these small company stocks, a lot of whom haven't been profitable lately, so they need to borrow money to keep going. The lower rate environment means a lot more for them. And what you're seeing, too, is that earnings growth for small caps starting to look up. And then we have the political uncertainty of who's going to be in the White House. Look, the market has gone up under Democrats and Republicans, but the market likes to know who it's going to be, and whether or not you agree with it or not, knowing that Trump's lead is widening the polls, tends to reduce some of that political uncertainty as well.
Yeah, I guess who knows if that'll last for the next couple of months, but that certainly has been behind some of what's happened in the markets, no doubt about it. And then in terms of whether we're in a good spot in terms of how people are positioned coming into this tough seasonal period of the year, and whether you think that there is a higher risk of some kind of give back in the near term.
Yeah, so you look at a couple different ways. We have some sentiment indicators that we watch closely, and things probably a lot of listeners follow. The VIX index, the volatility put-call ratios, they're showing a lot of optimism. And so to think that the market couldn't have a bit of a pullback for a variety of reasons, interest rates pop back up, maybe some earnings disappointment, could allow for the market to pull back here. But as long as the damage isn't too great in that trajectory of a few rate cuts coming up, decent year-over-year earnings growth, and the political uncertainty remaining far in the background, it means the market should be okay for the second half of the year.
In terms of that, the massive advantage of advances versus declines and all these kind of breadth thrust things that happen in the small cap rush higher, it seems a little bit out of sync with perhaps arguably where we are in the economic cycle. Right? Isn't that the kind of thing that you would typically see, kind of coming off a major economic low or some kind of, the crescendo of a big market sell-off?
Yeah, that's when they happen most often. I would say the last decade or so, we've gotten a few more of these after smaller sell-offs. But here's a nugget that really brings it home. Last week after the CPI report, it was the fourth best day ever for the small cap Russell 2000 index versus the large cap Russell 1000. The other three were the day of the Black Monday 1987 crash, October 10th, 2008, when Lehman Brothers went belly up. And then we also had a couple days before the pandemic low in 2020. I mean, those were major market events. and this happened off of a CPI report. So it is a little bit different from when these things normally happen. But the way we do things at NDR is we let the data speak for itself, and a broadening of the market on balance is a positive thing.
Yeah, and I guess in some ways it's a measure of just how extreme the underperformance was recently in a decent economy leading up to that huge bounce. So who knows how we account for it. Ed, always good to talk to you. Thanks so much.